which are competing, like project A, B, and the C. A, for example, wanting 15 million. B, for example, wanting 3 million. C, for example, wanting, say, 4 million. Call these 5 million like that. So you add these three. 5 plus 3 is 8. Plus 4, we are talking of 12. So there is no way we'll be able to implement the three competing projects simultaneously, given that our capital, which is available, is 10 million. So then we need to plan. We need to analyze the viability of these projects so that we get to select like 2 projects, which will be the most profitable, which will be the most viable, that we can do what here we can afford. So basically, as Raymond told us, this concept of capital budgeting is a process of decision making, getting to choose between these 3 projects I mean here, which ones will be the most profitable and will be able to fit within the capital that we have here, Now, ladies and gentlemen, I know in section 3, most of you dealt with capital budgeting techniques. Who is able to remember these capital budgeting techniques more so? Those techniques that are geared towards assessment of viability of the projects. Who is able to remember any 2? Methods of assessing the viability of projects. Who is able to remember any? Sorry for disturbing you a little bit. You know, I have to make this thing engaging. And also I use these at least to gauge you, to be able to see how many of us came from universities and were exempted from doing a FEM of section 3. So the capital budgeting techniques, what do we have there?
Say the
IRR, internal rate of return. I like that. Internal rate of return is one of the key tools of capital planning and budgeting.
Majority 30% NPV.
Net present value, NPV. Remember, the higher the NPV, the better a project is. Thank you very much. I can remind you one, payback period. So if, for example, you invest like 10 million in a project, and we have got, so if, for example, we have got this capital of 10 million, if we have the capital of 10 million here, and in these 10 million, ladies and gentlemen, somebody tells us to go for 2 projects. We have A, which will be able to pay us back. A will be able to pay us back, say, within 3 years. We have recovered, we have recouped all our capital investment. And then we have B, which will take 5 years to pay us back all our investment. So in terms of payback period, if the 2 projects, of course, we can afford to buy, or rather to, we can't afford them with the 10 million, we can only afford one. If you're told that you can only afford one, A or B, on the basis of payback period, which project will you go for? On the basis of payback period, which project will you go for? So somebody has told you 10 million. You want project A, you want project B, but you can't afford both. So you've gone ahead to analyze, to do the appraisals, and you've decided here to calculate their payback periods. Where A, you've realized A will take you 3 years, payback period of 3 years. B, payback period is 5 years. So which one is better between the 2? Most of them are saying A, yes, because the shorter the payback, the better off we are. Remember, risk increases with time. The more the time, the bigger the payback period is, the more uncertain things will crop in between here. So if you can get a project that you are able to invest in and the payback is like almost there and then that project is the best. The shorter the payback period, the better off we are. Thank you very much. How about profitability index? Is there somebody who spoke of profitability index there? Profitability index.
Yeah.
Uh-huh.
Peter.
Peter, profitability index. PI, profitability index, PI. Now, ladies and gentlemen, to us in section 5, those things we have mentioned are obiter dicta. They are just by the way. As here, we are required to study what we call advanced capital budgeting, although we'll be getting some questions touching on this, but ours basically is advanced capital budgeting, where basically we are required to introduce probabilities. We are required, ladies and gentlemen, here to introduce probabilities, we are required to introduce uncertainties, and of course here, under advanced capital budgeting, there are two environments that you're supposed to know. Here talk about there being two environments. There are two environments. There are two environments under advanced capital budgeting decisions. Number one, we have environment of risk. Environment of risk. Environment of risk. And if you can recall from your section 4 quantitative analysis, environment of risk is that environment where probabilities of the states of nature are given. And the risk environment, we are saying there that probabilities of the states of nature, probabilities of the states of nature are given. Probabilities of the states of nature are given. So exercise. If, for example, you are given some returns of X in form of percentages, and then they have given us 3 states here. They have given us state A, state B, state C. And then we have probabilities. We have 0.3, 0.2, 0.5. And then they give us like say 10, 20, 30 there. So we are required, ladies and gentlemen, to determine, number one, expected returns. Expected returns. Expected returns are the ones in section 4 QA we used to call expected monetary value. Expected monetary value. That is number one. And then number two, ladies and gentlemen, we are needed here to compute the standard deviation. Compute the standard deviation. And then number three, the coefficient of variation. I hope you are adding students who want to join us. Coefficient of variation. Coefficient of variation is popularly abbreviated as CV. It's popularly abbreviated as CV. Popularly abbreviated as CV. So remember here they want us to give them expected returns. These are X without an E. These are returns of security X. Returns of security X. They are actual returns of security X. And then number one, they want us to give them expected returns. Number two, compute the standard deviation. And then number three, coefficient of what here? Variation. So number one, it will be very important for us to appreciate the fact that here we are in the under which environment? Environment of risk. Environment of risk because of what here probabilities of the states of nature have been provided. Probabilities of the states of nature have been provided. Quite common in our exams, and it also forms a big base in advanced FM, also in advanced MA. Advanced MA, because when you go to portfolio, you get this arrangement there. You get this arrangement there. So, ladies and gentlemen, can you kindly get us started by giving us the way to calculate these expected returns? Who is able to show us how we will compute these expected returns? How shall we compute these expected returns? How shall we compute the expected returns? Is there somebody who has attempted giving us any answer there? Expected returns?
Apply.
Yes.
Rex
times probability. So what Abdullah is telling us is that for us to be able to get expected returns of X, this E stands for expected returns of X. According to Abdullah, we should come and take the actual returns of X times probabilities, and then at the end of the day, we sum them. In the environment of risk, ladies and gentlemen, we shall really be incorporating the risk factors into our cash flows. We shall be taking the probabilities given times the actual returns. So like what we are saying here, the expected return here will be equal to, take this 10 times its corresponding probability of 0.3, plus take 20 times 0.2, plus take 30 times 0.5. So please give us an answer. Please give us an answer. Give us an answer. Now from there, what figure are they able to give us? I wonder how you guys were able to hear me and yet my microphone was off, eh? Sure. So are you able to get me now loud and clear? I want to believe it's much better. It must be much better, much better. Thank you very much. So expected returns, we are computing them. We have here 10 times 0.3 plus 20 times 0.2, 20 times 0.2 plus 30 times 0.5, which at the end of the day gives me 20 what here? 22, which gives me 22, which gives me 22 here, which gives me 22 like that. So that is expected return. How about the second one, where they want us to give them the standard deviation? Number two, they want us to give them the standard deviation, which professionally we write like that, 0, and then we pull a tail. So they want us to give them the standard deviation of the X. I would want to see whether there is anybody who is able to give us an answer there, the formula. And please, the girl child, girls are never left behind at all. Today, I don't know what is happening because I've had Raymond speak, I've had Abdurai speak. I've not heard of any girl child here speaking. Girls are never left behind in any of my classes. Let this not be a unique class. Is there anybody who has a formula there? Just in brackets, what do we have there? Times okay. Now look at this. Look at this. It is a standard deviation. Deviation means what? Here? Difference. Deviation means difference. So our difference, ladies and gentlemen, is difference between what? Between the actual returns and the expected returns. So actual returns like that and the expected returns like that. And remember, for us, the standard deviation is a special deviation. We must come and do what the differences, we square them. And then now we have the probabilities being introduced. And then, ladies and gentlemen, remember that these deviations are many of them, so we must come and sum them up. So and once you sum them up like that, that total figure that you have will be called the variance. And remember, out of variance, for you to get standard deviation, you need to come and say what here? Square root like that. You need to come and say square root. You need to come and say the square root, yes.
Daniel did that.
Okay. Okay. Thank you very much. Thank you very much. So please look at what I'm doing. I don't want you to cram from the standard deviation from the square root. No. Remember what they used to tell us in high school. In high school, we used to say that standard deviation is root mean square. Root mean square. Root mean square. And we used to start from here, the squares. So first of all, we get the deviation. We square them. And then for a mean averaging, we multiply them with probability, sum them, of course, and then we end by getting what here? The root, the square root. Now, ladies and gentlemen, what I would want you to do for me, I would want you to come here right away, give us a column where we capture the deviation first. Rx minus ERX, we square this times probability. So I'm trying to follow this. The square will come in much later after summation. So I'm working with body mass. So we have Rx minus ERX. So what is Rx here? Rx is 10. So the first one here will be 10 minus ERX, which is 22. I come and square this. I multiply this with the corresponding probability, which is 0.3. 0.3. From there, we have the second actual return is 20. So we have 20 there, minus expected return that we got up there, which is 22. We square times probability, which is 0.2. And then we have the last return, actual return there, which is 30, minus 22. We square this times the probability, which is 0.5. So please give us answers. Give us answers. So what we have here, open brackets. So the first one is 10 minus 22. We square this times 0.3. Is there somebody who has gotten 43.2? The first one, 43.2. Abdullah, thank you very much. Go for the second one. The second one, what do we have here? And you see these questions are quite popular in your past papers. Very popular. I'll take you to your past papers, you'll be able to see. 20 minus 22. We square this times 0.2. Somebody must have gotten 0.8. And then the last one, now we have 30 minus 22. You square this times 0.5, which gives me 30 what here? 32. And now look at this. This one here, they want us to do what? To sum them up. You sum all these figures up. So please come and give us what we call the total variance. Give us what we call the total variance. So total variance 32 plus 0.8 plus 43.2 equals. Is there somebody who has 76? Yes. 76, thank you very much. 76, thank you very much. Now, ladies and gentlemen, from there, don't forget, we haven't reached Canaan. What we want to do, ladies and gentlemen, is to come and take out the square root of the variance for us to be able to get the standard what here? Deviation. The standard deviation equals square root of the variance. Square root of the variance, what figures do they have? The 8.7? 2. Thank you very much. Do you have any girl child who's not participating really?
I think it's Rania Agal. Rania.
It will be very hard for me to judge that. Okay. Thank you very much. Let's continue. Now, ladies and gentlemen, we have been able to get the standard what here? Deviation. We've been able to get the standard deviation. Once you give me the standard deviation, the next thing will be for us to get number 3, the coefficient of variation. The coefficient of variation, popularly called CV. And I would want to get from you, great students of mine, what is the formula of calculating CV? What is the formula of calculating CV? What is the formula of calculating CV? I'm waiting to hear from you. What is the formula of getting CV? Abdullah?
EMV stroke STD DEB.
Okay, that's okay, I've understood.
Then Rania, STD Last is DVN stroke ERX.
Okay, okay. Ladies and gentlemen, CV, to get CV, this should not be a big problem because we normally say that to get CV is always obtained by us talking over sex in percentage. Sex in percentage where sex is gender. Boy, girl, boy, girl, boy, girl. So ladies and gentlemen, meaning that for us to get CV, we normally take the standard deviation divided by x bar. X bar is the mean. What you could hear those two gentlemen talking about expected returns. So basically, x bar is the mean times 100. If my cameraman can see me up to here, CV will be equal to standard deviation all over ERX times 100 times 100 times 100 times 100. So now please try to plug in the figures. Try to plug in the figures. The standard deviation that we have here is 8.72 divided by ERX. ERX, what do we have over here for ERX? ERX, you guys gave me a figure of 22. You gave me a figure of 22 times 100 times 100. So 8.72 divided by 22 times 100. What figure do we have there? Somebody. Divided by 22 times 100. The figure that we have there, is there somebody who's getting 39.6? Thank you very much. 39.6%. 39.6%. Now let me ask you a question, and a simple question for that matter. Let me ask you a very simple question, and a simple question for that matter. If you're given two projects here, A, you're given B, and then they give you CV of 20%, and then B 30%. So two projects whose CVs have been given there. Which project will you go for? Which project will you go for? A 20%, B 30%. Which project will you go for?
Some are saying B, some are saying A.
Hey, is there anybody who's giving a reason?
No.
Ladies and gentlemen, remember basically they hire the CV, they hire the risk. And if the examiner defines the risk attitude for us, you'll get in most cases, the examiner telling you that the investor is a risk taker. So if the investor is a risk taker, then automatically we should always advise this person to go for a risky venture. So like now here, between A and B is more risky. B is more risky, A has got less risk. So A will be recommended to investors who are risk averse. If you're told that an investor is a risk averse, recommend to them projects with a lower CV. If the investor is a risk taker, always recommend to them projects, in this case, ladies and gentlemen, that are what here, which have a high CV, So in this case, it will be very important for you to say if the investor is a risk taker, advise them to go for B. If the investor is a risk averse, I advise him to go for what here for A. I hope that is clear. So environment of risk over. We go to environment of uncertainty. Environment of uncertainty. Environment of uncertainty, you can remember very well, under this environment, ladies and gentlemen, probabilities are not given. So B, environment of uncertainty. And for us, the most important thing is to appreciate that no probabilities under this environment. We don't have any probability, no probabilities. Probabilities are not given. So what will happen, ladies and gentlemen, here is that somebody will give you returns of X in form of a percentage. He'll give you 5 here, he'll give you 15, and then he'll give you 10. Then we have, of course, the states. The states are three. We have A, B, C. The states are three, A, B, C. The states are three, A, B, C, and then you will be required, number one, you give us expected returns. Number two, you give us standard deviation. Number three, you give us the CB, the famous CB, the famous CB, the famous CB. So here, I don't have to talk about anything. The most important thing that you're supposed to know under this, ladies and gentlemen, is that we do not have probabilities. We don't have probabilities for our states of nature. We don't have probabilities for our states of nature. We don't have probabilities for our states of nature. So then how do we get expected returns? I want to give you a minute. This is supposed to be a communal class. It's supposed to be a communal class. And you have this examiner wanting you to get expected returns. I mean, what do we do? Is there anybody who has an answer there? Nobody for now, right?
Raymond is 30.
Raymond is 30. What these students have known is that for us to be able to get expected returns, what we need to do is to come and give them the total returns, and then we divide them by what year? The number of those returns. So total returns divided by number of returns. So in short, you come and talk of the summation of returns of X, summation, not E, all over N. So come and add the total. The total, if you add the total, you get 20 plus 10 is 30. And how many numbers have we added? 3 of them. So then this will be 30. This will be 30 divided by 3 numbers, which will end up giving us what here, somebody? 10 as the average. Remember, expected return is the same as what here? Average. It's the same as the average. The average is there anybody who got 10 there? 10, many of them. Thank you very much. Now, ladies and gentlemen, we go to the second bit. The second bit, they want us to calculate the standard deviation. They want us to give them the standard deviation of X. Is there anybody who has an answer for this formula? Standard deviation of X. Please try out to give us the standard deviation of X. Give us the standard deviation of X. Give us the standard deviation of X, the standard deviation of X. Pata potea. Is anybody who has a formula for standard deviation there? We reward them. Ahmed, eh? We talk about Rx according to Ahmed minus ERX. At 8, because we have X, it has to be X. It has to be X. No problem. So we have Rx minus ERX. That is the difference, the general difference. But remember, this general difference here has to be squared, isn't it? Has to be squared. And ladies and gentlemen, now this time around, we don't have probability. So what do? We don't have probability. So the only thing we need to do is to come and then get the total. And then this total, come and average it. How do you average it? You subtract, or rather you divide by n minus 1. You divide by n minus 1, and then at the end of it all, we have our famous square root there. Please mark here that we are subtracting what here? We are subtracting that 1. We are subtracting that 1. We are subtracting that 1. Now, a good question will be asked, how comes in financial management, when we are getting standard deviation, we normally take away 1 from n? In finance, we must always take away 1 from n here, because in finance, when you are not given probabilities, the sample has to be small. We have a small sample. We have a small sample. And for all small samples, you don't divide the standard deviation sigma with just n, you divide by n minus 1. Meaning that we have lost a degree of freedom when we computed expected returns. We lost a degree of freedom, but you don't want to go to all that extent, because here we are not doing pure mathematics. Ours is more of an application. Ours is applied mathematics. These guys here discovered formulas for us. What we need to know is how do we apply them? How do we apply them? How do we apply them? Now, ladies and gentlemen, having discovered this, then what I need to do is to come and create a column up here of Rx minus ERX. And then we do what here? We square. We don't have probability. Any question that has probability is a good question. So there is no question, or there is no probabilities here. There are no probabilities here. So we have our actual returns, 5, 15, 10. We say minus. Expected returns. Expected returns, you guys are giving me a figure of 10, 10, 10, like that. So we'll come and do what to these ones? We'll come and square them times the probabilities. Probabilities are not given. You can even see myself here, I'm so much used to probability, they're not given. So what you're supposed to do is simply to come and give us these parameters from your calculators, and I expect a good student to give me the first parameter. You open brackets, 5 minus 10, you square. You square, give me a value there. 25, eh? 25 positive, isn't it? So many students here will write negative 25, and I know why. Because they do this thing in their mother tongue, they'll say 5 minus 10 is minus 5, and then when they square, no, any number squared like minus 5 squared is the same as minus 5 times minus 5, which will give me 25. How about the second one? The second one is as well, is 25 as well. And then, of course, we have the last one being 0. And if you look at this formula very well, after you've gotten this deviation squared, come and add for us. Add for us, what do we have here? Somebody, we have 50 there. When you add for us, we have 50 there. We have 50 there. So then come and plug in everything in the formula. So we have here, the total here is 50 divided by n, which is 3, 3 minus 1. 3 minus 1, 3 minus 1, 3 minus 1. So we have there 3 minus 1. Can somebody talk to us tonight? What do we have there, ladies and gentlemen? What is the final answer?
5.
They're getting 5, isn't it?
Yeah.
They're getting 5. Thank you very much. And I expect good students like yourselves to move a notch higher and give us the answer to part 3, where they want us to give them the CV, coefficient of variation, and please don't forget my formula. Don't forget my formula of coefficient of variation. Quite an interesting formula. Is that okay? What figure of CV are they getting? Yes.
Let's give him us 50%.
50%. Who is that?
Abdullah.
Abdullah, 50%. So what Abdullah has done, in this case, he has taken the standard deviation of 5 divided by expected returns, which was 10 times 100, which gives us 50%, which gives us 50%. Now, ladies and gentlemen, have they ever tested us on these things in our exams? Oh, yes, severally. Please get out your past papers. I want us to go to November 2016. Question number 2. November 2016. Question number 2. Boy, Moses Mapesa. Moses Mapesa. Moses Mapesa. Moses Mapesa. Moses Mapesa. I hope we have our past papers with us. They've given us Moses Mapesa. Moses Mapesa is in the process of evaluating investment in 2 companies whose percentage returns in the last 10 years, perhaps I could copy this for you. In the last 10 years, they have given us the percentage returns. They have given us percentage returns. So percentage returns, we have returns of company F, we have returns of company S. They have given me the years. So years, I've decided to put this in columnar form. I like it that way. Years 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then they have given me these figures for F37, 32. And then we have, ladies and gentlemen, 24, 29, 24, 29. And then for year 3, we have -7, -12 for the first year. -7, -12. And then we have 6, 1. Year 5, we have 18, 18, 18, 15, 18, 15. Then we have 32, 32, 32, 30, 32, 30. And then we have -5, 0, -5, 0. And then year 8, we have 21, 18, 21, 18. And then year 9, we have 18, 27, 18, 27. And then year 10, we have 6 versus 10. 6 versus 10 like that. And then we are needed to do something very easy. They want us to give them the correlation coefficient. They want us to give them the correlation coefficient. They want us to give them required. They want us to give them the correlation coefficient, cognizant of the fact that they have not given us any probability. No problem. So we are in which environment? Uncertainty environment. So I must know how to get the mean. I must know how to get the standard deviation in this environment. So I want you guys to do me a favor. Please come and give me the totals. When I want to get the mean, I'll take the total parameters, the total returns, I divide by n. So please add downwards, give me that. Even if I don't know what I'm getting, whenever I see many terms like this, I'll get the total first. So please give me the total. Give me the total. So they are getting the total returns here. They are getting total returns for the two. This one here, they're saying is 100 what here? 150. That's for F. How about the second one, total returns? Is there somebody who is able to get 150 here? Both of them should be 150. True? Both are 150. Thank you very much. Now, having gotten the total returns, then I will very easily give you expected returns of F. Expected returns of F. So expected returns of F, what do we have here? Expected returns of F, we'll take the total returns. Total returns of F, you can see it's 150 divided by number of items. The number of returns you added, number of years, here they are 10. When getting expected returns, we don't say minus 1. When getting expected returns, we don't say minus 1. You will take 150 divided by 10 like that, which gives us 15. And then we have expected returns of the second security, which will also be 150 divided by 10, which gives us 15 like that. Now, ladies and gentlemen, there is no way I can get correlation coefficient without getting the standard deviations. So I expect you, great students of mine, to come and give us the standard deviation of F. Give me the standard deviation of F. How do I get the standard deviation of F? It's quite easy. The standard deviation of F, ladies and gentlemen, will be returns of F minus expected returns of F. And then we do what here? We square. If I had a probability, I would be very happy, but there are no probabilities here. So what I need to do is to come and get the total there. And then at the end of the day, average this by dividing with n minus 1. And then, of course, we have the concept of what here? Big square. Concept of big square root. So now I expect you guys to move with a high speed and give me the standard deviations. Why are you dividing these with n minus 1 and not n alone? I told you in finance, whenever you're not given probabilities, the examiner will always give you small samples. Small samples are samples whose n is less than 30. Less than 30. But unless this examiner is another one, I've never seen that. Where an examiner gives you information without probabilities, and then he goes ahead to give you 30 numbers or 40 numbers, that is not a good exam. I've never seen that personally, never. And that is why we say that for standard deviation here, we shall always be dividing with n minus 1. So please give me the answer there. Give me the standard deviation of F very fast. Just generate your tables very fast. I'm giving you 10 minutes, both of them 10 minutes maximum. So is there somebody who has been able to get an answer for us?
Abdullah is getting 14.73.
According to Abdullah, standard deviation of F is 14.73. Is there any other student who has been able to get this standard deviation for F?
Ahmed is getting 14.733.
33. Thank you very much. So I have two students who have been able to confirm, who have been able to get this standard deviation of F. So I'm waiting for two more.
Not getting 14.733. Then
Mohammed.
is getting 14.734.
Thank you very much. So let's count it at two decimal places, 14.73. Thank you very much. But unfortunately, I've again not heard the sound of our girls. Mercy. Mercy Single, yes.
Mercy Single, and there's another Mercy calling us Mercy 24. Mercy 24, 14.73. Mercy Single, 14.73 and 15.04.
Mercy Single has even gotten the standard deviation of S, 15.03. Somebody has gotten the standard deviation of S as 15.03.
15.04.
15.04. So I would want to give you another 1 minute. You guys rush over very fast and give us the standard deviation of S as well. Very fast, you simply do your calculations very fast. Give us the standard deviation of S.
Ahmed is getting 15.048.
15.048. I'll still give this person who got 15.04 and give a mark to the student who got 15.048. That's one and the same.
Then Abdullah and Sheila are both getting 15.0.
And Sheila is good to meet you in this platform. Very good. And at least you've contributed 15.05. So it's like most of them are getting 15.05. 15.05. 15.05. Now, great students of mine, having gotten the standard deviations, could you kindly take me a notch higher and give me the formula of correlation coefficient? Who is able to remind us the formula of correlation coefficient? Just get a way of writing it in your statements there. Correlation coefficient equals who? Correlation coefficient equals who? Let me remind you. To get correlation coefficient, my great students, we normally standardize the covariance. To get the standard, or rather the correlation coefficient between F and S, it's supposed to be R. My handwriting is very bad. R. To get R between F and S, we normally take the covariance between F and S divided by standard deviation of F, standard deviation of what here? S. Anytime they want you to get the correlation coefficient, take the covariance between F and S, divide this by the standard deviations of the two securities. Covariance means what here? The shared variance. Covariance between F and S. Covariance between F and S. Before I give you the formula, is there any student who can be at a position of remembering this formula? Covariance between F and S. Somebody give us that particular parameter. Covariance between F and S. What do we have there? Covariance between F and S. What do we have there? Very clear. Is there anybody who can answer for us there? Covariance between F and S. Fortunately, some of these things we encountered them in high school. Yes. Yes. Some of us may tell me, Mwalimu, but high school was so many years. So I'm waiting for the formula. Okay? So covariance, we are saying that covariance is the shared variance. And for us to get the covariance, ladies and gentlemen, what we're supposed to do to get the covariance, you're supposed to come and take the deviation of F times the deviation of S. Deviation of S. If we had probabilities, we would have multiplied these parameters here with our probabilities, but we don't have any probability. So what we need to do is to come and just sum like that. And of course, in the absence of probabilities, there is a concept of what here averaging. So averaging, ordinarily, if it was a large sample, we would have said divided by n. But because these are a small sample, we need to come and say divided by n minus what? N minus 1. N minus 1. So you take the deviation of F multiplied by deviation of S, you sum, and then whatever total you get, you divide by n minus 1. Remember the deviation of F. Deviation of F is the actual return of F minus expected return of F. Minus expected return of F. Minus expected return of F. Multiplied by the deviation of S. Deviation of S will be the actual returns of S minus the expected returns of S. And then everything to be divided by n minus 1, but not before you sum there. Remember, there's a summation there. There's a summation there. So, ladies and gentlemen, come up here and give us, come up here and give us a column where you'll be able to get those deviations. So we have here RF minus ERF multiplied by RS minus ERS. So I'll come and create a column here. We start with the RF. So RF is 37 minus ERF, you guys gave me a figure of 15, into RS is 32, you gave me a figure of 15, and then I'll be able to say equals. Like the first figure there will be open brackets 37 minus 15 close brackets times open brackets again 32 minus 15 close equals, I'm able to get 300 what here? 74. And then now you do the same for all the others, and then down here you give us the total. Down there 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 you give us the total. So please work a little bit fast. Be a little bit faster. Give us the totals. So is there somebody who has been able to give us the total there? Somebody.
The first one, 1874.
Mm-hmm.
Then second one, 208.22. Then Mulai giving us the first figure, 1874. Then was the Sheila also 1874.
So I want the summation down here. Is there someone who has been able to give us the summation down here? The summation, just summation alone. The summation alone.
Almost I think 1874.
1874. 1874, thank you very much. 1874, thank you very much. And because of that, now I should be able to get R between F and what here? S. We should be able to get R between F and S. So to get this R between F and S, we say take the covariance between F and S divided by the respective security standard deviations like that. So whatever you have obtained here, remember it's not yet covariance. Whatever you have here as 1874, if I was to come back here, my covariance, ladies and gentlemen, my covariance between F and S is the summation of returns of F minus expected returns of F into returns of S minus expected returns of S divided by N minus 1. So they're giving me a figure of 1874 divided by N which is 10. 10 minus 1 will be 9. So could you kindly give me this figure? 1874 divided by 9 equals what? 1874 divided by 9, they must be having an answer. 208.22. 208.22. So come back here. The covariance is 208.22 divided by the respective standard deviations. Unfortunately, I deleted mine, but I remember there was one who was coming to 14 point something. Standard deviation of F. I remember there was one that was coming to 14.73.
Yeah.
Times standard deviation of S was 15.05. 15.05, thank you very much. So then that one should be able to give us these parameters. Very fast. So what do we have there as our R, my great students? .94. That is the correct answer. And I want to believe, ladies and gentlemen, that you would have done the same. You would have done the same in your exams. Now, ladies and gentlemen, mention there very fast for us methods of handling. So it's supposed to be advanced methods of handling risk and uncertainty. Very famous in our exams, uncertainty. Now, Shayla asked a very important question. When do we use the N in our division? If you remember, we had our standard deviation formula, for example, of X, which was our X minus ERX squared times probability. Probability are not there. Come and the sum here, and then you divide by what here, N minus 1, before you think of taking out the square root there. So Sheila was interested in knowing when do we use this denominator as n alone, as n alone. Ladies and gentlemen, normally use denominator as n alone for large samples. And the large samples do not exist in finance. That is why in finance, when you are not given probabilities in finance, you come, always we use n minus 1. Because it's very hard for you to get crazy examiner giving you like 30, 40 samples. I mean, it's not possible, not possible. So these methods of advanced methods of handling uncertainty, which you are supposed to know, which are very common. We shall start with the first one, which is called sensitivity analysis. So right there, sensitivity analysis. Sensitivity analysis. Sensitivity analysis. SA. Sensitivity analysis. SA. So tell us there that the focus of sensitivity analysis, the focus of sensitivity analysis is to determine the effect, is to determine the effect on net present value, or net present value due to a change, of a given variable, due to a change of a given variable. So in short, sensitivity analysis is a what if analysis. What if the price changes by this particular percentage? What effect will that change have on our net present value? So the focus of sensitivity analysis is to determine the effect on net present value due to a change of a given what year variable. So of course, those variables that will change slightly, but have a very big impact in net present value will be said to be what year very sensitive. Will be said to be very sensitive. Tell us that sensitivity analysis is divided into two. Sensitivity analysis is divided into two. Sensitivity analysis is divided into two. We have number one, the break-even point analysis. Break-even point analysis. Break-even point analysis. And then number two, we have what we call the impact analysis. Impact analysis. So break-even point analysis, break-even point analysis, break-even point analysis. And then number two, we have what we call the impact analysis. Impact analysis. So we start with the break-even point analysis. Mention there break-even point analysis. 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 So we have here break-even point analysis. Now, ladies and gentlemen, what do you know about break-even point? Break-even point is that point at which net present value equals 0. In QA, in AMA, we used to talk about the point of zero profit, but in finance, at break-even point, NPV will be equal to 0. So you're saying there that at break-even point, net present value of a project equals who? Net present value of a project equals 0. Net present value of a project equals 0 at break-even point. So for you to understand what I'm talking about tonight, I would want us to mention their illustration. Illustration, ABC Limited. ABC Limited. For you, for those of you who have this handout, you don't have to, of course, write the question. It's on page 6 of this handout, where they have told us that ABC Limited is considering whether it should purchase an equipment to to increase its production. The equipment cost equals 500,000. The equipment cost equals 500,000. And then we have useful life. Useful life equals 3 years. 3 years with a scrap value of 80,000. A scrap value of 80,000. With a scrap value of 80,000. So we are told here that once we acquire the equipment, revenue will increase by 600,000, and operating cost will increase by 400,000. 400,000. This is per annum. That is per annum as well, because they told us that for each of the 3 years, those 3 years, then that tells me straight away that I'm dealing with a question of annuities. 600,000, 400,000 respectively. The company's cost of capital is 10%, cost of capital is 10%, and the tax rate is 30%, and the tax rate is 30%. Required, number one, calculate net present value. And then number two, SE of the cost of equipment, SE or the cost of equipment, SE of the cost of equipment, comma, scrap value, and the sales revenue. Scrap value and sales revenue. So sensitivity analysis, SE sensitivity analysis of the cost of equipment, we have the scrap value and the sales revenue. So if you allow us, we shall go ahead and give the examiner net present value. And of course, that has to come from you. Net present value. What do you think will be the very first thing that we should do for us to be able to get the net present value? Net present value. For us to get the net present value, what are we going to do? I'm giving you exactly 1 minute to think through this. So then the very first thing that we need to do, ladies and gentlemen, for us to be able to get a net present value, we have to analyze the profits. We must analyze the profits which are going to come from this particular machine. And the first thing that we shall do under profitability analysis is to compute depreciation. Depreciation here is relevant. Why? Because we have been given the rate of taxation. Whenever you are given a rate of tax, the first thing that you ought to do is to calculate depreciation. So please come and give us depreciation first. Why are we calculating depreciation? We are calculating depreciation because tax has been given. So we have depreciation per annum. To get depreciation per annum, ladies and gentlemen, we are taking the initial cost of the equipment minus the scrap value all over n. The examiner has not told us to use reducing balance. Whenever the examiner is silent in financial management, we always use straight line method. This machine, when it's brand new, will cost us 500,000 minus the scrap value. The scrap value given here is 80,000. We come and divide this by n. Number of useful years are 3. Number of useful years are 3. Number of useful years are 3. So get your calculator there. Very first, what do we have here? 500,000. So we have 500,000 minus 80,000 equals divided by 3, which gives me 140,000 per annum. Every year, that asset is losing 140,000. Is losing 140,000. Now, ladies and gentlemen, the moment I have that, now I can do a profit stroke cash flow statement. A profit stroke cash flow statement. So I have here profit stroke cash flow statement. Profit stroke cash flow statement. Profit stroke cash flow statement. So we have here increase in revenue. That once this machine comes, the revenue will be going up by 600,000. My figures are in shillings thousands. My figures are in shillings thousands. So revenue will be going up by 600, and then we have the cost going up by 400. So when you subtract, you'll be able to get your 200 there. Now, ladies and gentlemen, the moment I get this 200, of course, this is profit. But now I have to define which profit. But unless I'm told otherwise, the first profit which I come across will be called a profit before depreciation and what year? Tax. The very first profit that I come across by in finance will be called profit before depreciation and the tax. So once I have this profit, come and less depreciation, which you have been able to compute up there in shillings thousands, is 140. So we have 200 minus 140, which will give us 60. So this becomes profit before what year? Tax. It's only tax we haven't levied here. So go ahead and tax, so less tax. What is the rate of tax? It's 30%. So 30% of 60 gives us what year? 18. 30% of 60 gives us 18. Subtract. When you subtract, ladies and gentlemen, what are you able to get? When you subtract, ladies and gentlemen, here, we are able to get 60 minus 18. 60 minus 18, 60 minus 18, we have here 42. 42. So what name do we give to this good figure of ours? It's after taxation. So this becomes profit after what? After tax. Once I have profit after tax, to change now these to cash flow, we'll come and add back what here? You come and add back depreciation. Depreciation of how much here, somebody? Of 140. Depreciation of 140. So 42 plus 140 gives us what figure? Gives us 182. And this now becomes your most important parameter in discounting purposes called the cash flow. So I want to ask you a question. This 182, what type of a cash flow is this? Is it an annuity or an irregular amount? Annuity or irregular? Annuity or irregular? Annuity or irregular? It's annuity because you have seen so many things that are on a per annum basis. You can see depreciation was per annum for 1 year, revenue per annum. That's one of the ways you can use to know that you have a regular cash flow. So the cash flow that we have here is an annuity. Now that we have an annuity figure, ladies and gentlemen, how do we change this to NPV? How do we discount this to NPV? I want to give you 1 minute exactly. Give me NPV out of this. Most students from the formulas I'm able to see, they have remembered very fast that in terms of cash flows, we always have two types of cash flows. We have what we call irregular cash flows, and then we have what we call regular. Regular, these are the annuities. The annuities. Remember, irregular, we normally use what we call PVIF. PVIF is present value, interest factor. PVIF is present value, interest factor. And for us to get this present value interest factor, we normally talk of 1 plus R, raised to negative N. Present value, interest factor, we normally talk of 1 plus R raised to negative what here? N. How about annuities? Annuities, we normally use what we call PVIFA. The annuities, we normally use what we call PVIFA, which will always be obtained by taking 1 minus the formula that we have up here. This simpler formula. 1 minus 1 plus R raised to negative N, everything to be divided by R. This 182 that we have there is an annuity, and that is why we want to use this formula, the second formula. So the figure that we have up there is an annuity, and that is why we want to use this formula. This question, by the way, it's a past paper question, so don't underrate it. So we have our PVIFA being equal to 1 minus. We have here 1 plus R. The cost of capital has been provided in the question as 10%. 10%. Raised to how many years? Negative number of years are 3. Number of years are 3. Divide this by R, where our R is 10% again. So 0.1. So could you kindly try to give us this figure using your calculator? You take your calculator like this live. You say 1 minus 1.1 raised to negative 3 equals divided by 0.1, which at the end of the day will give us, if I'm not wrong, 2.4869. Is there anybody who got that figure? Remember, R is our cost of capital.
Sheila and
Sheila.
Ahmed.
Thank you very much. Now, having gotten this figure, then to get net present value is not a problem at all. To get net present value is not a problem at all. To get our NPV, my cameraman can be able to see me up to here. What I need is to come and talk over the cash flow coming in itself. 1 is 2. Multiplied by the PVIFA. Multiplied by the PVIFA minus the initial outlay. So then what do we have at the end of the day? It will be 182 multiplied by PVIFA, which is 2.4869 minus the initial outlay. The initial outlay, we were told to buy this machine, we needed 500,000 shillings. Our figures are in thousands. So then this will give us what figure of net present value? Will give us what figure of net present value?
Most of them are getting minus 47.3.
Minus 47.38.
38.
And remember, these figures are in shillings what year? Thousands. So if this figure is correct, then this project I have to mention there for a mark. I have to mention, ladies and gentlemen, that this project is not viable. The project is not viable. The project is not viable. The project is not viable. Remember, anytime you have a negative NPV project, the project will be taken not to be what here somebody, not to be viable. If it's positive, then the project is viable. I hope that is okay. I hope that is okay. So we go to number 2 of this question. Number 2, they want us to do something very easy. They want us to evaluate this question in terms of sensitivity alongside how many variables there are? 3 of them. So carry out sensitivity analysis of the cost of the equipment, scrap value, and the sales revenue. So mention their sensitivity analysis of the cost of equipment. Sensitivity analysis of the cost of the equipment. Sensitivity analysis of the cost of the equipment. Sensitivity analysis of the cost of the equipment. Now, I would want you to understand us once and for all. For sensitivity analysis, we normally evaluate one variable at a time. So we are saying that it is one variable at a time. One variable at a time. So meaning that we shall only take the cost of the equipment to be different. So in this case here, we will let the new cost of the equipment, to be equal to what here? To be equal to X. The new cost of the equipment should be equal to X. Remember our NPV. The other NPV that we did, ladies and gentlemen, our NPV. And you will allow me, ladies and gentlemen, to give you some story here, first of all, before I even go back to this sensitivity analysis of the cost of the equipment. Now, if you recall, we got our cash flow. We got our cash flow as 182 using a long method. Now, if I wanted to get this cash flow using a short method, I would have gotten this cash flow this way. What I would have done, ladies and gentlemen, would have been to come here and say that our cash flow is revenue minus cost, right? And then we go ahead to basically ladies and gentlemen, here to tax this. So we talk of what here, 1 minus tax. Now, if I do it this way, it means that I have not subtracted depreciation. If I take revenue minus cost, I tax directly, I have not depreciated. I have not subtracted depreciation. It means that later on, I must come and add what we call the depreciation tax sheet. Listen and listen to me very well. There is this formula which tells us always that our cash flow is profit before depreciation and tax, come and tax without subtracting depreciation, and then later on you add depreciation tax sheet. Please write that. Very, very important. Depreciation tax sheet. This is depreciation times the rate of taxation. And to get this profit before dividend and tax, what are we doing? We are taking revenue minus what? Cost. We are taking revenue minus cost. 1 minus taxation. 1 minus taxation of 0. What here? 7, because 1 minus the rate of tax is 0.3. So 1 minus 0.3 gives me 0.7. Plus the depreciation figure that we computed ourselves. The depreciation figure that we computed ourselves, if my memory serves me well, was 100 what year? 40. Was 140 times the rate of tax, which is 0.3, times the rate of tax, which is 0.3. So could you kindly multiply this for us? What do we have there? 600 minus 400 equals times 0.7 plus 140 times 0.3 equals. You'll be able to see we shall get what we call 100 and what here somebody? 182. So we have there 182, 182. And then, ladies and gentlemen, something has just come to my mind. The NPV that we got up there is not right. We forgot the terminal cash flow. We forgot the terminal cash flow. We forgot the terminal cash flow. The figure that we got up there is wrong. I don't know how that escaped from our minds. The figure we got there up there is wrong, and of course, human is to error. So please let us revisit up there. But I hope you have been able to see how we have gotten that 182, this cash flow, which is the same as the other cash flow that we got. We'll be coming back to this, but let us correct a mistake that we did up there. Remember, we have two types of cash flows here. We have two types of cash flows here. Ladies and gentlemen, we have our annuity cash flow of 182, which has to be multiplied with the PV fund. And then remember, we have a lump sum amount of 5,000. In terms of thousands, that figure is supposed, is it 5,000 or 50,000? Let's see, so you don't make a mistake again. Ladies and gentlemen, let's see there. The scrap is supposed to be 80,000. The scrap is 80,000, so this is supposed to be 80. Lump sum amount coming to us at the end of year 3. At the end of year 3, lump sum amount coming to us at the end of year 3. So if it's a lump sum amount, it will be called an irregular cash flow. And if it's an irregular cash flow, then I'll have to come and multiply it with what here somebody up there, PV. I'll have to come and multiply it with PV. So remember, the 182 is an annual figure, so it's a PV thing. But this terminal cash flow, which is coming to us, ladies and gentlemen, at the end of year 3, is the PV. And if it's PV, ladies and gentlemen, remember the formula of PV is 1 plus R raised to negative n. So then this one here will be 1.1 raised to negative 3. It's coming to us at the end of the third year. So meaning that I need to come and talk of 80 times whatever figure that we have here, which will be 1.1 raised to negative 3, which will give us 0.7513. 0.7513. And of course, this one we had already gotten this one. So what I need to do is to just go back to that equation of mine. I revisit it and talk about this, that our NPV will be equal to our 182 times PV. This is the first cash inflow. And then I have another cash inflow in the form of the scrap. We'll be selling this thing at the end of the third year, and we shall realizing 80. But this 80, because it's a futuristic figure, it has to be discounted. So you must come and multiply this with PV. And then now don't forget to subtract the initial outlay of 500. Sorry for this, this is a term that I omitted. I don't know how we omitted it. Terminal cash flows must always be included in all our workings. So ladies and gentlemen, we have here 182 times our PV, who is able to remind us our PV, it was 2.4 something. 2.4 something. Our PV was 2 point what here somebody PV. I expect somebody to remind me this figure. PV was what here somebody. Nobody's talking to me tonight. They must be lost.
Must say 2.4.
2.4.
868.
868. Thank you very much. Plus 80. Is there somebody who's giving a different figure?
Actually, it says 69, not 68.
2.4.
869.
69. Thank you very much from Mercy. From Mercy. Plus 80 times the PV. PV, you have given me the figure of 0.7513 minus 500. So come and take out your calculator boldly. Talk of 182. Talk of 182 times 2.4. 869 plus 80 times 0.7513 minus 500. Then at the end of the day, what figure will we get? We shall be getting here 12.72, which happens to be a positive NPV. And if it's positive NPV, you simply say into brackets there, the project is viable. If it's positive, you simply tell us that the project is viable. The project is viable. The project is viable. The project is viable. Sorry for that. Now we go to part 2, where they want us to do sensitivity analysis of many variables, but you've just said that sensitivity analysis can only be done for one variable at a time. Sensitivity analysis can only be done for one variable at a time. One variable at a time. So sensitivity analysis is for one variable at a time.
It's saying hanging. I don't know what it means. Saying hanging, just put hanging.
Hanging, eh? Maybe it's is it our system really? Are the other students able to get as well? Do we have any network issues on our side?
I think it's okay.
It's okay. So maybe that brother of ours needs to look at the network from his side. So come straight, ladies and gentlemen, and talk to us about sensitivity analysis. Remember where we stopped, we said that our cash flow will be equal to R minus C multiplied by 1 minus taxation plus the depreciation tax shield. So R is revenue, which was 600 minus cost of 400. We have here 1 minus tax of 0.7 plus depreciation, which was coming to 140 times tax of 0.3, which gave us 182. Why do I want to show you this? I want to show you this, ladies and gentlemen, because sensitivity analysis, we shall be using, ladies and gentlemen, the equations approach. We shall be using the equations approach. And remember, the sensitivity analysis we are getting is sensitivity analysis of cost of equipment. Cost of equipment is sensitivity analysis of the cost of equipment. So what we shall do, my friends, is to let the cost of equipment, to be X. Actually, let the new cost of equipment to be equal to X. Let the new cost of equipment to be equal to X. And then what I will do is to come and write my NPV equation. My NPV equation, how will my NPV equation look like? Ladies and gentlemen, my NPV equation here will be equal to, we'll come and take 182, the one that we got there, which is an annuity figure that we need to come and discount. So how do we discount this? We multiply this with PV-FA. We multiply this with PV-FA. Remember, we have got two cash flows. So we have our annuity that we shall multiply with the PV-FA plus our scrap value. Our scrap value, the scrap value, our memory serves as well, was 80. And this scrap value must always be multiplied with PV because it's a one-off figure. And then from there, come and subtract our initial outlay. Remember, the new initial outlay that we have is X. So we'll come and subtract the initial outlay, which is X here, and then we equate everything to who? We equate everything to 0. we subtract the initial outlay, and then we equate everything to 0 because this is a break-even point sensitivity analysis where NPV is supposed to be equal to what? To 0. This is, I'm repeating again, ladies and gentlemen, this is break-even point sensitivity analysis where our new net present value should be equal to 0. And then now you come and evaluate X. Make X the subject of the formula. So what we have here, my great friends, we'll talk of 182 times the PV4, which must give me a figure of 2.4869. I hope this figure is correct. $2.4869, is it correct? Thank you very much. Plus 80 multiplied by 0.7513. We got this PV. Minus X, my great students, this then should be equal to F. 0, I mean. So come and combine the two. Come and combine the two. When you combine the two, what do we have? We have 182 times 2.4869 plus 80 times 0.7513, which will give us 512.7198. Say 512.72. 512.72 minus X equals 0. So meaning that you have to take this to the other side. So it will be minus X equals minus 512.72. Meaning, ladies and gentlemen, that our X will be equal to 512.72, a figure that you must underline. So this is the new initial outlay, a new cost of equipment. This is the new cost of equipment. So this is the new cost of equipment. New cost of equipment. But you see, sensitivity analysis has to end up at percentage change. So come and give us the percentage change. So how do we get this percentage change? It is new minus old divided by old times 100. New minus old divided by old times 100. Question? Right? So you take the new, like now here the new cost of equipment is 512.72. You subtract the old, you divide by the old again. Times what here? Times 100. Times 100. So what do we have over here? I know first when I do this, it looks quite confusing, but after some time you realize, after I do the second question, you will become professionals in this. So we have our percentage change being equal to the new figure that we have. The new figure that we have is 512.72 minus the old cost of equipment, which was 500. Everything to be divided by what here? 500. And then whatever we get times 100%. So could you kindly give us that percentage sensitivity? Percentage sensitivity. What figure are we getting there, somebody? Percentage sensitivity.
Stabilize getting 2.5%.
2.5%.
Then I'm at 2.544.
54%. Thank you very much. It means, ladies and gentlemen, that our cost of equipment can increase by this percentage before the project becomes undesirable. So this is the allowance that the model is giving us. That we can play around, we can dilly around with the cost of this equipment as we are gaining up to that percentage. The moment we exceed that percentage, then the NPV of the project becomes negative. So the project becomes what here? Undesirable. The project becomes undesirable. I want to repeat something here. For you to understand what we're talking about tonight, ladies and gentlemen, there are things I would want you to know. This equations approach, you normally call it the equations approach. The equations approach of sensitivity analysis. If you're to get like revenue of say 600, And then you have cost, ladies and gentlemen, of say 400, just like the other question that we had. And then we have depreciation of 300. And then the rate of tax given is 30%. And then you are required to give us cash flow. Before I take you back to sensitivity analysis, I would want us to understand the equations approach. So they have given us revenue, they have given us cost, they have given us depreciation, we have tax, and then they want us to give them cash flow per annum. Could you kindly try out this, the cash flow per annum? There are many ways that I could use to get this cash flow. One of the ways, ladies and gentlemen, is to come and use the statements approach, where we have our revenue of 600, we have our cost of 400. When you subtract, you are able to see 200. This becomes profit before depreciation and what here? Tax. 200. Of which now will come and subtract depreciation. Of how much? Of 300. Which is here. So when you get this, of course, you'll be able to get minus 100. This is what we call profit before what here? Profit before tax. Once I get the profit before tax, I now need to come and tax. So come here and less taxation. Taxation at what percentage here? 30%. So could you kindly give me 30% of minus 100? Is it proper for us to tax a loss? Are we going to tax losses? What are they saying? No or yes?
No. No. Saying no, Shane is saying yes.
Uh-huh.
Vanita is saying yes.
Yes. Remember in finance, Abdullahi, it doesn't matter. Even if it's a loss, it has to be taxed. So 30% of minus 100 gives us minus 30. Gives us minus 30. So please come and subtract this profit before tax minus the tax itself. So minus 100 minus 30 will give us minus what here? Minus 70. So then this gives us what figure? This figure is what we shall call profit after what here? Profit after taxation. So after I get the profit after taxation, I'll come and add back depreciation. Add back depreciation over how much here? Somebody of 300. So when you do that, you'll end up getting our cash flow of what here? Of 230. But now for sensitivity analysis, we don't follow this approach. For sensitivity analysis, we normally use what we call the equations what here? Approach. Sensitivity analysis, we normally use the equations approach. For sensitivity analysis, ladies and gentlemen, use equations approach. So if it is sensitivity analysis, the examiner wants you to evaluate, come and give us cash flow always using the equation which looks like this. R minus C into 1 minus taxation. So we are taxing before we subtract depreciation. So come and add back the depreciation what here? Tax shield like that. So then this R is 600 minus the cost. Cost was given to us as 400 into 1 minus tax, which will be 0.7 because 1 minus 30% is 0.7 plus the depreciation itself, depreciation which is what here? 300 multiplied by the tax, which is 0.3. 0.3. So ladies and gentlemen, then at the end of the day, what will we get here? Come and take open bracket here, 600 minus 400. Whatever I get times 0.7 plus 300 times 0.3, which will end up giving me 200 what here? 230. 230. So among the things that I would want you to take home tonight, number one is this equation, which I'll be using in our next class intensively. This equation is so important for us. And then number two, the take home will be the PV formula. PV formula. And then we have those formulas of expected returns. We have the formulas of standard deviations, covariances, and correlation coefficient. Otherwise, have a lovely night. Bye-bye.